Welcome to the deep dive. We're about to plunge into the dynamic world of pharmaceuticals.
Right.
It's a sector where, cutting-edge innovation, vast global reach, and robust financial health constantly intersect.
Absolutely. And when a major player reports its quarterly results, it's fascinating.
It's not just about numbers, is it? It's really a window into the future of medicine and market strategy.
Exactly.
Today, our focus is Dr. Reddy's Laboratories and their recent Q1 FY26 earnings.
That's right. Our mission today is to go beyond the headlines, really dig in and extract the most important nuggets of knowledge from their conference call and their financial reports.
Okay.
We want to help you understand their performance, their strategic moves, and what it all really means, where this global company and maybe even the broader pharmaceutical industry are headed.
And you'll discover, I think, a company that's pretty adept at navigating a complex landscape. They seem to be managing some very real market pressures in certain areas while strategically investing and expanding in others.
All with a clear aim, it seems, for consistent double-digit growth.
Right. So let's unpack this and see how they're actually doing.
Okay, let's start with the overall financial snapshot for Q1 FY26. Dr. Reddy's reported consolidated revenues of just under $1 billion US,
Wow.
or about 85 billion Indian rupees. Now, that marks an impressive 11% growth year over year.
It sounds great.
It is, but interestingly, it remained flat quarter over quarter.
Okay, so that quarter-over-quarter flatness, that might signal a potential plateau, doesn't it?
Yeah.
What about profitability? I saw they hit an EBITDA margin of 26.7%.
Yeah, they did, actually exceeding their own 25% aspiration.
So what does that tell us? About their operational efficiency, maybe?
Yeah.
Especially in what seems like a challenging market.
Well, it's a strong indicator, I'd say, of tight cost control and efficient operations. It shows they're really making the most of every dollar earned.
Okay.
Their profit after tax attributable to equity holders also saw a small 2% year-over-year growth. That reached about 166 million US, or just over 14 billion Indian rupees.
But wasn't there a sequential dip there?
There was, yeah. We saw an 11% sequential decline in that specific profit metric.
And the gross margin dynamics are, well, particularly interesting. It stood at 56.9% for the quarter, which is a pretty significant decrease compared to last year.
Yeah.
They said that was mainly due to price erosion in generics and maybe lower operating leverage.
Exactly. Price erosion is a big factor in generics.
But crucially, it did show a modest improvement, about 134 basis points sequentially. Partly balanced, they said, by a better product mix.
Yeah, and that sequential improvement is key. It shows they're actively, managing their product portfolio.
Suggests some internal adjustments are already having a positive effect, perhaps.
Right. Now, if we connect this to the bigger picture, their strategic investments are also quite telling. SG&A expenses, selling, general and administrative, they increased by 13% year over year.
Okay, up to about 299 million US. Why the increase?
Well, they termed it strategic growth-oriented investments, mostly in their consumer healthcare business, specifically nicotine replacement therapy, or NRT.
The NRT acquisition.
Exactly. And also a joint venture for nutraceuticals with Nestle. These are clearly seen as, long-term growth drivers.
And for the full fiscal year, they're projecting SG&A to be in the 28 to 29% range of sales, so quite high.
It is, reflecting those investments.
What about R&D? Research and development spend was around 73 million US. That's about 7.3% of sales.
Yeah, that spend was largely flat year over year, but it did decline 14% sequentially.
Sequentially, okay.
They highlighted targeted investments, though, specifically in complex generics, APIs, active pharmaceutical ingredients, and their biosimilars pipelines.
Right. And they also mentioned flexibility in R&D spend, possibly adjusting it from that 7.5% range for the full year.
Yes, depending on their P&L performance, they indicated it could potentially go down towards 6% or even up. So there's some wiggle room.
And underpinning all this, their balance sheet looks quite strong, doesn't it?
It does. The quarter closed with a robust net cash surplus of 341 million US.
That's a nice cushion.
And an annualized return on capital employed, or ROCE, of 22%. That's a solid financial foundation, gives them a lot of flexibility, especially when looking at future opportunities or acquisitions.
Okay, so while their overall financial health looks pretty strong, the real story, I think, unfolds when we look at their specific markets.
Agreed.
Let's start with North America. It sounds like that presented some significant challenges this quarter.
It did. Their North American business, which is primarily U.S. generics, experienced a 17% year-over-year revenue decline.
17%, that's steep.
It is, and a 4% sequential decrease as well, totaling $400 million US dollars. They attributed this softness mainly to price erosion in selected products.
And lenalidomide was the big one there.
Well, lenalidomide was the primary example, yes. And also some timing of procurement by certain customers played a role.
Now, that sharp anticipated decline for lenalidomide in Q3, that's not just a revenue hit, is it? It feels like a textbook case of how swiftly market dynamics can shift post-exclusivity.
Absolutely. When more companies enter the market with larger quotas, prices can fall fast. Dr. Reddy's foresight here, acknowledging this, it just emphasizes the critical need for robust pipelines and diversification in the generics space.
So they expect similar sales next quarter, Q2, before that sharp decline hits in Q3.
That's the projection, yes. A similar magnitude before the drop. It was well anticipated, as they put it.
Okay, so despite these challenges, what are they doing in the U.S.? I saw they launched 5 new products during the quarter.
They did. And they expect a pickup in launch momentum for the rest of the fiscal year.
Which should, hopefully, support recovery and drive some growth.
That's the plan. Overall, they're projecting the base business in the U.S. to be somewhere between flat to low single-digit growth.
Which signals they are actively trying to mitigate the impact of that lenalidomide erosion.
Exactly, trying to fill the gap.
So if North America presented these headwinds, where exactly is Dr. Reddy's finding its growth engine then?
Well, that leads us straight to their impressive performance in Europe.
Oh, Europe.
Yeah, their European generics business, for example, delivered $131 million US dollars in revenue. That's a staggering 124% year-over-year growth.
Wow, 124%. What fueled that?
Primarily, it was that acquired nicotine replacement therapy, the NRT portfolio we mentioned earlier.
Right, Haleon acquisition.
Exactly. But they also introduced 13 new generic products in Europe during the quarter. So organic growth, too.
And how's the integration of that NRT business going? They picked that up from Haleon, right?
Yes. They said it's progressing successfully. They've completed transitions in the UK and the Nordics already.
Huh.
The next phase will bring on board additional markets like Canada, Australia, and some other Western European countries.
And that business itself, the NRT one, it contributed quite a bit, didn't it? About 6.7 billion Indian rupees.
It did, and showed a 12% sequential growth as well. They noted it has no seasonality and is currently exceeding expectations, even beyond its normal mid-single-digit growth trajectory.
That sounds like a really solid acquisition then. What about margins on that?
Expected to be around 25% EBITDA, so quite healthy.
Okay. And beyond Europe, what about emerging markets?
Also a good story there. That segment reported 14.04 billion Indian rupees in revenue, showing 10% year-over-year growth.
Driven by
higher volumes, and 26 new product launches across multiple countries. So broad-based growth.
Any specific countries stand out?
Well, what's particularly notable is their Russia business.
Oh, Russia, yes.
It delivered 17% year-on-year growth in constant currency terms, underscoring its continued momentum despite, all the macroeconomic challenges and geopolitical situation.
Right. And their commentary on Russia was direct. They stated that sanctions implemented by others are not relevant to us, and they see it, if at all, it's an opportunity.
Very direct language, yes.
Now, while Dr. Reddy's clearly sees this as an opportunity, what are the potential risks there? Maybe reputational or even long-term market access challenges in maintaining that kind of position, even if direct sanctions aren't currently affecting them.
That's definitely a critical question to keep an eye on. Companies operating globally often have to navigate this delicate balance between market opportunity and, geopolitical realities and perceptions. It's a tightrope walk.
Indeed. Okay, shifting focus to their home turf, India. How did the India business perform?
Very well, actually. It delivered 14.71 billion Indian rupees in revenue. That's an 11% year-over-year increase.
Solid growth. What drove that?
Mostly new product introductions, some pricing power, and strong commercial execution on the ground. According to IQVIA data, Dr. Reddy's maintained its position as the 10th largest player in the Indian pharmaceutical market.
And outpacing overall market growth, I believe.
That's right. They launched 5 new brands in India. 2 of them were highlighted as innovative assets, which really caught my eye, too.
Yeah, Beyfortus, that's an RSV vaccine, right?
Yeah.
A totally new approach for respiratory syncytial virus.
Exactly. Huge potential need there. And the other was Sensimune, a novel immunotherapy product for house dust mite-induced allergies.
Again, targeting specific unmet patient needs. Seems like a smart strategy.
It does. They mentioned having a field force of about 10,000 people across 50 teams in India.
Wow, that's a large presence.
It is, and they're committed, they say, to reaching the top 5 in the Indian market, focusing on organic growth through these kinds of innovative products and also some relicensing deals.
Okay, one more segment to cover here, the PSAI business. Pharmaceutical services and active ingredients.
Right. That's about $95 million in revenue. That's 4% year-over-year growth.
Okay, growth.
But a 14% sequential decline.
Why the dip sequentially?
Largely attributed to seasonal weakness and some under-recovery of overheads. Normal fluctuations, perhaps.
Okay, but the outlook is better.
Yes, the business momentum is expected to pick up in the coming quarters. They're aiming to return to a double-digit growth trajectory for the full fiscal year.
And they filed 12 DMFs globally, Drug Master Files.
They did, which, as you know, is crucial groundwork for future product approvals using those APIs. Shows the pipeline is active.
And their CDMO business, the contract development and manufacturing side that's growing too, targeting $100 million this year.
Yes, and projecting $250 to $300 million by 2030. So that's clearly a segment they see significant potential in.
Okay, so that covers the current business performance. Now let's shift gears to their future pipeline. This is where some of the really big bets are being made, isn't it?
Absolutely. This is about the long game. Their discussion around semaglutide, which is a GLP-1 product, was particularly bullish.
Yeah, they view it as a many, many years opportunity. I think they even said a decade of GLP-1 products.
They did. And for listeners who might not be tracking this super closely, GLP-1s are this class of revolutionary drugs that are just profoundly reshaping diabetes and obesity treatment.
The market potential is truly immense.
It really is. So specifically for Canada, Dr. Reddy's is targeting approval for their semaglutide between October and November this year.
Okay, aiming for a launch right at the loss of exclusivity, or LOE, in January.
Exactly. LOE, just to clarify, is when that patent protection expires, allowing generic versions onto the market.
And the key assumptions are, being able to manufacture and ship to Canada, which apparently has no patent, just exclusivity and getting the regulatory green light.
Correct. Those are the hurdles. They mentioned the demand for this product looks crazy, which really underscores the market potential.
What kind of capacity are they planning for?
For calendar 2026, projected capacity is 10 million pens, increasing to 12 million pens for FY27.
Which they believe is sufficient to gain meaningful market share.
That's their assessment. Initially, they plan to launch only the generic Ozempic formulation. Submissions for generic Wegovy will come later in the year.
And what about launches outside Canada? Rest of world?
Those are expected in calendar 2026. They're targeting 87 countries, actually. Key markets like India, Brazil, Turkey are expected probably after March 2026.
And they specifically called out the obesity market in India, believing it's going to be significant.
Yes, due to very, very clear unmet needs there. Their whole GLP-1 portfolio is pretty expansive. 26 products mentioned. They're aiming to be first to market with differentiated plays.
It really sounds like they're all in on this category.
It certainly seems that way. It's a major strategic pillar.
Okay, what other big pipeline assets did they discuss?
Yeah.
Abatacept. That's a biosimilar, right?
Yes, another significant biosimilar. Phase 2 trials are progressing. So far, so good was the phrase used.
When are results expected?
November 2025. If those results are positive, they plan to submit the BLA, the biologics license application, quickly.
Aiming to be on time for market formation around late 2026, early 2027.
That's the goal, starting with the IV formulation first and then the subcutaneous one about a year later.
And the investment in those abatacept trials won't recur after November 2025.
Correct. That will free up some R&D capital, presumably.
They also talked about pembrolizumab, a biosimilar to Keytruda.
Yeah.
That's a huge cancer drug.
Massive. They're doing this through a strategic collaboration with Alvatech. Co-development, manufacturing, commercialization.
Aiming for launch in many markets, including the U.S. and Europe.
Yes. And importantly, they said, with much less burden of a prior investment because of the partnership model.
Smart. And the trial design allows them to get all relevant indications without multiple trials. And it could be interchangeable.
That's the expectation. Interchangeability is a huge advantage for biosimilars, allowing pharmacists to substitute directly for the brand name. Big commercial plus.
Any other key biosimilars mentioned for the U.S.?
Yes. Nucimab, partly to prepare the commercial team for abatacept, as it has a similar customer base, and daratumumab.
Okay.
And rituximab will be available in the U.S., but through a partnership with Fresenius.
Got it. And liraglutide. Another peptide.
Yes, another GLP-1 type product in their peptide pipeline. Planning a launch in the coming quarters, aiming to be first to market in some areas, like for the Saxenda indication.
So it's a really broad and ambitious pipeline covering generics, biosimilars, and these high-potential peptides.
Definitely diversified and aiming high.
Okay, beyond the financials in the pipeline, it's probably worth touching on their operational efficiency and their commitment to responsible growth.
Agreed. Things like regulatory oversight are always important.
Right. They mentioned recent U.S. FDA inspections. The Middleburg API facility in New York received a Form 483 with 2 observations.
A 483 means investigators observed conditions that might violate regulations.
But it was subsequently classified as VAI, voluntary action, indicated after their response.
Correct. VAI essentially means the observations don't warrant immediate regulatory action, like a warning letter. It's a less severe outcome.
Okay. And similarly, their CTO5 API facility in Telangana also got 2 observations on its GMP inspection, good manufacturing practices.
Yes. And they submitted timely responses there, too.
And the FTO11 formulation facility in Andhra Pradesh got a Form 483 with 7 observations during a GMP and pre-approval inspection.
Right. And they stated they'll respond within the required timelines, and they also expect a VAI classification for that one.
So overall, it sounds like they're managing regulatory scrutiny reasonably effectively, navigating the process.
Seems that way, yes. Standard part of operating in this industry.
And on a different note, their commitment to sustainability got recognized, right? By the Carbon Disclosure Project, CDP.
Yes, their rating was elevated to an A in the climate category for 2024. That apparently places them among the top 2% of global companies.
That's impressive.
They also retain leadership status in water and supplier engagement categories. It shows a more holistic approach to their business beyond just the bottom line.
Good to see. Now, thinking about future growth again, what about investments? Capital expenditure, CapEx?
CapEx for the quarter was relatively low, $18 million US. Full-year CapEx is expected to be in a similar range to last year, focused heavily on peptides and biosimilars capacity.
Okay. And they mentioned having significant financial capacity for M&A or business development, something like $2 to $2.5 billion.
That's what they indicated, yes. A substantial war chest. They're actively exploring strategic partnerships and acquisitions to diversify and strengthen their portfolio.
So definitely signaling intent to grow both organically and through external deals.
Absolutely. And one final point on finances, they also highlighted their flexibility to adjust discretionary costs.
Like travel, meetings, consultants.
Exactly. They said they could potentially cut those by 500 and 600 basis points without impacting sales growth, if needed.
Which emphasizes that their priority is growth, but they have levers to pull on the cost side if market conditions require it.
Precisely. Protecting the P&L while fueling growth.
Okay, so we've navigated through the complexities of Dr. Reddy's latest financial results. We've tried to move beyond just the headlines to uncover the underlying strategies and future prospects.
Yeah, hopefully you, the listener, now have a clearer understanding of how they're handling those current market challenges, while also strategically positioning themselves for that longer-term growth.
What's really striking here, I think, is Dr. Reddy's strategic agility.
Mm-hmm.
You see them managing immediate pressures, like that lenalidomide price erosion, by shifting focus, leveraging acquisitions like NRT,
Right.
all while making these significant long-term bets on high-potential areas like biosimilars and what they're calling the decade of GLP-1 products.
It's almost like a two-front war, isn't it? Battling price erosion in one major market while simultaneously trying to aggressively expand and innovate in others.
It really is.
Which brings us to a final thought for you to ponder.
Yeah, this raises an important question, I think. What stands out to you as the biggest opportunity or perhaps the biggest challenge for a global pharmaceutical company like Dr. Reddy's right now?
Especially as they strive to balance those immediate demands of diverse, often tough markets. With the immense long-term and very expensive investments required to bring potentially groundbreaking new therapies like these GLP-1s to a world that seems to be in urgent need of them.
Huh.